Hello and welcome to this recording which will explain using marginal costing in short-term decisions. We're going to look at three types of decisions: special orders, make and buy, or cost and revenue planning. The first one that we'll look at is special orders. So if we consider a hairdresser, they use absorption costing to set the price of a haircut. Currently, she's expecting to cut 20 people's hair per day, and the overheads are expected to total £70 per day. So from that, we can work out an overhead absorption rate. Budgeted overheads, £70, divided by budgeted activity, 20 haircuts, gives us £3.50 per cut. So using that, the hairdresser can work out the total cost of providing a haircut. The direct material cost is the cost of the hair products at £2.50. The direct labour cost, £10. Overheads absorbed, £3.50, gives us total cost, adding those together, £16. Now she needs to make a profit, and she looks to make a markup of 25%. So add 25% onto £16 and selling price for the haircut £20. So using traditional costing, £20 per haircut. However, what if the hairdresser has no customers? Then a customer walks in through the door, asks for a haircut, but says they only want to pay £15. Now the hairdresser normally charges £20. So what should she do? Well, if we consider the additional costs that would be incurred if she goes ahead and does this haircut, there will be the hair products. So that's the direct material. There will be the labour. £10. Now the overheads, they will be incurred whether she cuts anybody's hair or not, because they are a fixed cost. So the only additional costs that the hairdresser will incur if she decides to cut this customer's hair is £12.50. The customer is willing to pay £15. So we've got a selling price of £15. So therefore there is going to be a contribution of £2.50. Remember, contribution is contribution towards fixed costs. So that £2.50 that is made on the haircut can help to go towards the overheads that are being incurred. So it would seem viable to accept this customer's suggestion and cut the hair for £15, because it's better to make £2.50 than make nothing at all, because the overheads still have to be paid. However, it is a special order. It should be only a one-off. If the hairdresser decided to cut everybody's hair for £15, then she would not make enough to pay her overheads in full, and eventually would be making a loss and possibly see the closure of her business. The other thing to think about is the non-financial factors. What's going to happen if she agrees to do this customer's hair for £15? Firstly, the customer may come back on a regular basis and always want the haircut for £15. She may tell her friends, and they will also want haircuts for £15. So we could result in all customers wanting their haircut for £15 rather than the normal £20, or word of mouth, the hairdresser could actually end up with a huge number of customers because they feel that they're getting a good deal at £15 a time. So when you're considering special orders, financially, you would base your decision on whether you were still making a contribution, but you would also need to consider the non-financial factors. So that's the first type of decision with marginal costing. Now we're going to move on to the second type of decision, which is make or buy. So we have this example, and the decision is, do we make the product ourselves in-house, or do we buy from an outside supplier? So a particular product has a selling price of £40 and it's costing £20 per unit in variable costs and £10 in fixed costs. So the total cost of the product, £30. We can buy that same product from an outside supplier for £25. So would that be a better option? Rather than making it ourselves, should we buy it in? As in the previous example, we need to think about the fixed costs. They are £10 per unit. Now in the short term, whether the organisation decides to make the product or buy the product in, they are still going to incur that £10 per unit of fixed costs. That's not going to change. So in making the decision, we need to consider what will change. Making the product has variable costs of £20 a unit. So those are the costs that will be incurred if the product is made and will not be incurred if the product is not made. If we buy it in, we can buy in at £25 a unit. So again, that's a variable cost, because if we buy it in, we'll pay £25. If we don't buy it in, we won't pay £25. So what we're comparing is the variable cost of making, £20, to the variable cost of buying, £25. And in this case, it's obviously cheaper to make the product. So the decision would be to make. Remember, this is a short-term decision. Marginal costing always used for short-term decision making, because in the short term our fixed costs are not going to change. So we're only considering the costs that will change with the decision, and those are the variable costs. This decision may change if we were given further information. For example, it could be that the organisation could make better use of their spare capacity if they bought the product in rather than making it. Maybe they could make another product that is more profitable to them, and that could affect the overall decision. Again, as in the last example, we need to consider the non-financial factors. So financially, in this example, we would make the product. If financially it had indicated that it would be cheaper to buy in the product, what we would then also need to consider are things like the quality of the product that we're buying in. Is it to the same quality as the product that we make ourselves? What about the reliability of the supplier? Will they meet our delivery dates so that we don't let down our customers? Will the price that they've quoted remain constant, or is it likely to increase in the near future, which would then affect our profits? On the plus side, it may be that the supplier has specialist knowledge or expertise in this product and can produce a much higher quality product than the one we're producing ourselves. So these are the sort of factors that need to be considered alongside the financial factors. So now we'll move on to the third decision. This is cost and revenue planning. Now with cost and revenue planning, what we're looking at is the effect it will have on a profit of a business if we were to consider reducing selling prices so that we could increase the quantity sold, or maybe should we increase our selling price, which would reduce quantity sold, but would it improve our profits? And we're going to work through this example to see the effects of changing selling prices. So we have a company called Medicar. They produce first aid kits for cars. They currently produce and sell 200,000 kits per year. The cost of producing the kit, direct material £1.50, direct labour £1, variable expenses £2, fixed production overheads 50p, fixed administration overheads 40p. And the kits are sold for £7.50. So the managing director is considering two options. Option 1 is to reduce the selling price to £7. And the managing director feels that that's going to increase the sales by 10,000 kits per year. Option 2 is to increase the selling price to £9. Based on that, it would be expected that sales would fall to 150,000 units. But they also expect the fixed production overheads to fall by £20,000. And what we're required to do is to make recommendations as to which option, if either, should be undertaken. So, first thing we need to do, because we've been given our fixed production overheads as a unit figure, we need to work out what they are in total, because we will need to know what our total fixed overheads are. So our fixed overheads, production overheads, .50 a unit, and that's based on 200,000 units. So that comes to £100,000. Admin overheads, 0.40, again 200,000 units, comes to £80,000. So our fixed overheads, £180,000. Now remember the definition of a fixed overhead. It remains fixed. It does not change with output. So we know that our fixed overheads are £180,000. So they're going to remain at £180,000 unless we are told any different. It's the unit costs on our fixed overheads that would change, not our total. Now, we're asked to make recommendations as to which option, if either. So should we go with option 1? Should we go with option 2? Or should we remain with what we're currently doing? So this means that we're going to have to work out the profit that we're currently making, because then we'll have a benchmark to assess whether option 1 or option 2 are worth considering. Now, the quickest way to approach these sort of questions is to initially calculate your contribution per unit. So we have a selling price of £7.50. Variable costs, we've got the direct material is £1.50. The direct labour is £1, and we got the variable expenses, £2. So that's a total of £4.50. We need to deduct that, and we're currently making a contribution of £3 a unit. So that's the contribution per unit. If we now multiply that by the number of units we are selling, we get the total contribution. So £3 times 200,000 units gives us 600,000 in contribution. To get from contribution to profit, we take away the fixed costs. So we have a profit of £420,000. So that's what they are currently making. And to see how quick and easy this calculation was, because we worked on the contribution per unit, then multiplied by the number of units, and took away the fixed costs. That's the current situation. Option 1 we're going to reduce the selling price to £7, and it's expected to lead to an increase in sales of 10,000. So we'll use exactly the same method. Selling price is now £7. Our variable costs are not changing, so we're still going to have a total of £4.50 in variable costs, which we need to deduct. Gives us a contribution of £2.50. So we can see the contribution has fallen. So that was our variable costs. But we're going to see an increase in the units sold. They're going to go up by 10,000. So our contribution per unit multiplied by 210,000 units gives us a total contribution of £525,000. Take away fixed costs of 180, and we have the profit under option 1 of £345,000. So we can immediately see that that is obviously not as good as our current profit of £420,000. So we would not consider option 1. So what about option 2? We increase the selling price to £9. Based on that, we would expect our sales to fall to 150,000 units. Also, we're expecting our overheads to fall by 20,000. We're not told that the variable costs are going to change, so they're going to remain at £4.50 a unit. So we do the same sort of calculations. Option 2, if I put it alongside option 1, selling price has now increased to £9. The variable costs, we've not been told that they're going to change, so we assume they stay the same at £4.50. So that means under option 2, we're making a contribution of £4.50 a unit. So on a unit basis, that's an increase. However, because of the increased selling price, we were now expecting only to sell 150,000. So our total contribution, £4.50 times 150,000, which gives us £675,000 in contribution. We need to know the profit figure, so contribution minus fixed costs will give us the profit. Now our fixed costs have been £180,000, and they remain at £180,000 unless we are told any differently. And it is expected in option 2 that we would see a fall in our fixed costs. They would be expected to fall by £20,000. So our fixed costs, which were 180,000, will now be 160,000. So minus fixed costs of £160,000 means that under option 2, we'd be expecting a profit of £515,000. Okay, so just note here our fixed costs, 180,000 minus 20,000. So we have 3 profit figures. Currently, the current situation we have a profit of 420. I'll just highlight these profits. I'll get my highlighter. 420,000 under the current situation. Option 1 is expected to give us 345,000, and option 2 is expected to give us 515,000. So it would be recommended on these figures that we go with option 2. That's giving us the highest profit. Now, if you're doing any of these cost and revenue type questions, I suggest that you try and get into good habits in terms of how you calculate them. Always look at identifying your fixed overheads firstly. So as you could see in this example, they were given on a unit cost. Now that unit cost only applies when we sell 20,000 units. So multiply out your unit costs by your quantity and you have your fixed overheads. And then use those fixed overheads in every decision, because they won't change unless you are specifically told in the question that they'll change. Second thing to do, once you've picked out your overheads, is to calculate a contribution per unit. Now always try and work on contributions per unit. It is so much easier than working on total figures. So contribution per unit is the selling price minus the variable costs. Then multiply your contribution per unit by your quantity and you have a total contribution, and then take away your fixed costs and you have your profit. So if I just make a note of that, so we've got contribution per unit is equal to the selling price per unit minus variable cost per unit. Then total contribution is equal to the contribution per unit times the quantity sold. And profit is equal to your total contribution minus fixed costs. So I hope you found that useful and you'll be able to apply it to a variety of questions and scenarios. Okay, so thank you for listening and goodbye.